Good day, fellow investors. So there was this comment about REITs, and I haven't looked at REITs for a while with this video explaining the clear mechanics of investing in REITs, interest rates, dividends, and all you need to know if you're interested in REITs. The link to this video will be in the description below. But this is exactly how I do things. I watch sectors, I analyze them, and then I circle and I come back to those sectors to see if those are, at the moment, good value investing opportunities. The interesting ones go on my covered stock list on my research platform, where I then select investments for my portfolios. Then the comment was about how REITs stock prices have significantly declined. This is Prologis from 168 to 109. So the dividend is up, things look better from an investing perspective, and therefore it's time to check what's going on. Vonovia has done well, really well, as that is a special situation REIT. We'll discuss each REIT specifically. You'll have the timestamps in the description below and on the video. East Group was the question also. Realty income, and you can see already here the difference in dividend yield, 330. Realty already 575. If we go to others, Alexandria 7.51, and here we can see a significant decline in stock prices, about 60 more percent. 222 a few years ago, now we are at 70. Allied Properties, we're going to Canada, I think, 36, now 11, and Smartcentres a little bit more stable, but also down. And let's immediately start with Smartcentres for the analysis. So there is a distribution, this is Canadian dollars, so the dividend yield now is around 7.3%. They do these retail situations in Canada, and then on top of it they are developing their smart combinations with building things on top of their retail and land and everything. And they have good occupancy, good tenants. The key tenant is Walmart, and they are developing going forward, creating value by that diversification into condos, townhomes, business, just trying to maximize the value from that land. If we look at the situation, the last quarter, pretty much stable, renewed rent going up. This is a benefit of REITs, that they can usually increase prices while hopefully their costs stay a little bit more stable. Funds for operations up just a little bit, so nothing wrong there. However, you have to compare this number to other REITs, and you'll see that adjusted debt to EBITDA is 9.6 times, which is significant. Therefore, the key there is debt, and the maturities are a little bit skewed to the longer term, but that is also the key risk when it comes to REITs, the interest rate situation going forward. If we look at the balance sheet, the average cost of debt is 3.87%, and then the key risk also for REITs is if this goes to 7%, which has historically happened, then it will look very ugly. If it goes down to 3%, the investment will look very good. Still, let's say, stable there, but you never know how those things will change in time. From a summary perspective, if we take the 7% dividend, 3% inflation growth, then we are at a 10% return from Smartcentres. Let's look at Allied Properties. So the stock has fallen significantly. They have a wide, again, urban workspace portfolio across Canada. Okay, business space work has been hit significantly, and you can see here how the free funds from operations is down over the last 12 months, and that is then reflected also in the stock price. They are investing, always building sources of capital, new debts, low cost of capital, and their financial targets are to have net debt to EBITDA below 9x. However, when you have such a 9x, and you look at the total debt there that they have, small changes in interest rates create again a risk, and that has been then materializing. As you can see, net debt as multiple of an annual adjusted EBITDA 11.6. Those debt ratios, covenants quickly deteriorate and everything looks uglier, as we have seen here with the huge decline in the stock price. So this is the key risk with allied properties in line with the demand. So I don't know what will happen here. The thing is that once this key risk with debt creates an issue, then it becomes very hard to control and things can get ugly. The market likely fairly pricing the risk and reward here. Let's go to the next, another decline there, Alexandria real estate. And whenever I look at whatever slide deck from a REIT, everyone has the best properties, highest quality, asset base, whatever, everything is best, lasting endurance, superior result, everything always so great in the presentations, highest quality, asset based. So they do this scientific space for biochemical, pharmaceutical and things. However, things are not going as well as they have planned there over the years. The interest rate debt is 3.95%, but compare that to the US 10-year Treasury, which means that likely that debt cost will grow over time, and that is then putting pressure on the company. Yes, they have 12 years of maturities, but there are covenants, there are things, there are all those small letters that nobody reads. But if you want to know your REIT, you need to read the small letters. The dividend yield is there, going higher as the stock is going lower, but they don't discuss occupancy here because it's not a good number. So let's discuss tenant collections. However, if I look a little bit at occupancy, I think they are at somewhere 90%. They have declining earnings per share, still good cash flows in their guidance, but things are not developing. Here you have the occupancy going down, and if there is the risk that it goes even lower, then it becomes difficult to, let's say, manage everything. The market is then repricing everything, and you see this. If they can increase the occupancy, cash flows, keep the interest rates lower, things will improve. If not, things might deteriorate further. They need to sell assets, and then it gets very ugly. This is the risk side of investing in REITs. Realty Income Corporation also down, not as much as others that we have discussed, because this is a better REIT for sure. They have this huge portfolio. They have also started expanding in Europe. Now, let me tell you immediately, this Europe expansion is just for the management to make more trips with their wives or mistresses to Europe. That's the only logic to go into a new market. When you know your market well, like the US, why would you go to Europe where there is money printing and local competition as much as you wish? So it's just for trips and increasing their salaries. But okay. The portfolio there diversified across various things there, property type focused on retail, strong balance sheet. You can see here net debt to EBITDA 5, not 10. So that is already then lowering the risk long term. 5 is more in line with the normal stable US REITs. Canadian REITs carry more risk. Still growing funds from operations, nothing wrong there. They expect okay returns, but we have to keep in mind that interest rates are not 2.3%, they are 4%, and we cannot predict where will those go in the future. But with the debt and everything, those costs might increase. I have calculated here around $1 billion of yearly payments for interest on a 4% interest rate. If, I don't know, the US Treasury goes to 6%, the required yield from Realty might be 8%, and then you start thinking about the 8%. If you're already happy with the 5.75, 6%, let's say, yield now, owning those properties, nothing wrong with investing in REITs. East Group, immediately you see the lower dividend yield, you see the lower decline, which means higher quality REIT or perceived higher quality from the market. Geographic focus more on the south. They're also showing these increases in vacancies, and you can also see this will impact severely the REIT market if this continues like this. If we have a recession, it goes even higher. Also, development, this is no development. This is still development adding more than economic growth, especially if it gets into a recession. It can get still very ugly, but for now it looks good, likely good tenants. Vonovia, we have discussed it, and then it was a crisis situation, and it has rebounded 50% as the company has managed to, let's say, stabilize itself. It is based on asset sales, still lower and lower rates in Europe. As you can see, that saved it. So that is the volatility that you can get, positive or negative, if you invest in riskier REITs. I'm looking a little bit at the guidance, stabilization. Here, the dividend yield there is something, but I have no idea where this will go. It will depend on the real estate market in Germany, recession situation, money flows. So not really a stable one, as it is dependent on asset sales. This was the best REIT a few years ago, likely still the best quality business REIT. However, here when the dividend was, what was it, 2%, it was crazy expensive because the market is myopic and they thought that the low interest rate environment will last forever. That changes, and that is the risk. Even if you own great logistics real estate that is growing, high in demand across the globe, nothing wrong, fortress balance sheet, you can see here debt to adjusted EBITDA 4.9%, and therefore Prologis, when it comes to this quality, it just depends on interest rate. When interest rates were at zero, the stock reached 160. As interest rates went up, the stock adjusted to the new environment. Still quality, still growth, they still expect 5, 6, 7% funds from operation and dividend growth over time. So that is something, but it will all depend on interest rate. If interest rates go lower, the stock will go higher. If interest rates go higher, the stock will go lower. And perhaps 3.71 is already something, but not that attractive to me to gamble with these businesses. To conclude on REITs, I think that short term there is an efficient market. The market cannot predict interest rates, therefore it is inefficient in the long term, but interest rates are still low to make a value investment bet on REITs. That's also the triple whammy here. If interest rates go higher, asset values go down, interest costs on debt go up, perhaps even there is a recession, occupancy and income goes down, contracts, debt covenants. So there is a whammy situation. Of course, if interest rates go down, everything of that is positive. So REITs are an interest rates game. An issue I have with REITs, there is always this question of constant growth. They all need always to grow, and we all know that you cannot always grow, especially in a highly competitive environment. You cannot grow at the same profits. So for now, REITs are not for me. If you like that dividend, you can compare it to others. We have discussed also other dividends in our quadrant video, so you might want to check that. Check also my REIT video in the link in the description below. The quadrant will also be there, and then you compare investment opportunities. You build your portfolio for the long term, and REITs, if not having too much risk, can really be quality components to anyone's portfolio if you like owning that. At the end, investing is about owning and being rewarded from owning the businesses. If you like to own these REITs, nothing wrong with that. If interest rates go up, you will have higher dividend yields possibly, and therefore you can reinvest and lower prices and accumulate. Thanks for watching. I'll see you in the next video.